Hello and welcome to Explain the Charts, your go-to channel for detailed market analysis. Today is October 25th, 2025, and we're breaking down the latest news and price action for Bitcoin, or BTCUSD. The market is at a critical juncture, with conflicting analyst opinions and major economic events on the horizon, so let's get right into it. First, we'll cover the news that's driving the market sentiment right now. The entire financial world is holding its breath for next week's US October Consumer Price Index report and the subsequent Federal Reserve policy meeting. These events are expected to heavily influence whether the Fed begins cutting interest rates, a move that many believe would be a massive bullish catalyst for assets like Bitcoin. Currently, Bitcoin is trading around the $110,000 to $111,000 level, caught in a state of compression after a volatile few weeks. The narrative is split, with some analysts predicting a breakout past the $112,000 resistance if the CPI data comes in soft, potentially reigniting the rally towards year-end targets as high as $200,000. On the other hand, the bearish sentiment is just as strong, if not stronger, in the short term. Standard Chartered's Jeffrey Kendrick, who was previously very bullish, has revised his outlook, now calling a dip below $100,000 inevitable due to broader macro fears. This sentiment is echoed by on-chain analysts who point to metrics suggesting short-term holders are under pressure, potentially leading to a deeper correction before a recovery. One analyst even mentioned a historical pattern that could see a brief, sharp dip towards the long-term holder realized price near $37,000, though this is an outlier perspective. The main driver for the recent bearishness was the sudden market crash on October 10th. This was directly attributed to President Trump's announcement of 100% tariffs on Chinese goods, which sent shockwaves through all markets, not just crypto. Despite this, institutional interest continues to grow, with firms like Jane Street disclosing stakes in miners and companies like Zeta Network adding Bitcoin to their treasury. This creates a fascinating tug-of-war between short-term macro fears and long-term institutional adoption. Now, let's turn to the charts to see how this news is reflected in the price action. We're starting here on the daily chart to get the big picture view of BTCUSD. As you can see, the start of October was incredibly strong, with Bitcoin hitting a fresh all-time high just above $126,000 on October 6th. This was the peak of what many called the euphoria phase of the bull cycle. But let's zoom in on what happened next, because it perfectly correlates with the news. Here we are looking at the daily candles from October 6th to the 13th. After hitting that peak, you can see a few days of consolidation before this massive red candle on October 10th. On that single day, the price crashed from an open near $121,700 all the way down to a low of about $103,300. This nearly 15% drop in one day was a direct reaction to the tariff announcement, wiping out weeks of gains and completely shifting market sentiment. The volume on this candle was significant, confirming the intensity of the sell-off. Following the crash, we see a bounce, but the price has struggled to reclaim its previous levels, which is a classic sign of a market absorbing a major shock. Zooming back out to the full daily chart, we can see the aftermath of that crash has defined the market for the past 2 weeks. The price has been largely range-bound, oscillating primarily between $107,000 and $112,000, just as the news reports have suggested. This period of low volatility and consolidation is often the prelude to a very large, decisive move. Let's identify our key levels based on this price action. The most critical support level to watch is right around $107,000. You can see that the price has tested this area multiple times in the last 2 weeks and has so far held strong. A definitive break and close below this $107,000 level on the daily chart would be a very bearish signal, reinforcing the calls for a drop to $100,000 or lower. Conversely, our primary resistance is sitting firmly at the $112,000 mark. This level has acted as a ceiling, capping every significant bounce since the crash. A strong break above $112,000, especially on high volume, would be the first major bullish sign, suggesting that the correction might be over and the uptrend could resume. Beyond that, the next major resistance zone lies between $116,000 and the psychological $120,000 area. So, for long-term traders, this is a clear waiting game, waiting for a confirmed break of either support or resistance. Now let's switch to the 15-minute chart to analyze the most recent price action from yesterday, October 24th. Here on the 15-minute chart, we are looking at the price action from the second half of yesterday's trading session. The day saw a push-up towards our key resistance area, peaking around $112,400 early in the day. However, as we can see here, that momentum faded throughout the afternoon. The price action became choppy and indecisive, trading within a tightening range. Notice how the volume tapered off into the end of the day. This indicates that traders are becoming hesitant, choosing to sit on the sidelines ahead of the weekend and, more importantly, next week's high-impact news. The price action spent the last few hours consolidating around the $111,000 level. This behavior reinforces the broader picture we saw on the daily chart. The market is coiling up. For short-term traders, scalping between the local highs and lows might be an option, but the risk is high as a volatile move could happen at any time. The key takeaway from this short-term view is the lack of conviction from either bulls or bears at the moment. Everyone is waiting for the next major catalyst. Let's go back to the daily chart for a final summary. So, to recap, here are the key takeaways and what to look for. The market structure is defined by two critical levels, support at $107,000 and resistance at $112,000. A break of one of these levels will likely dictate the direction for the coming weeks. From a bullish perspective, if next week's CPI data is favorable and hints at future rate cuts, we could see a powerful breakout above $112,000. I would give this scenario a 50% chance, and its likelihood would be reinforced by a surge in trading volume and sustained closes above that resistance. A break could quickly target the $116,000 to $120,000 range. From a bearish perspective, if inflation data comes in hot or if other macro fears intensify, a break below the $107,000 support is highly probable. This would open the door to a test of the psychological $100,000 level. Given the current macro uncertainty and the revised analyst outlooks, I would also give this scenario a 50% chance. A break of $107,000 with conviction would be a strong signal to expect further downside. The most important thing to watch for in the immediate future is the US CPI report. Its outcome is the most likely catalyst to break this period of consolidation. Until then, expect continued range-bound and choppy price action. Please remember, this content is for informational purposes only and is not financial advice. You should always conduct your own research and consult with a professional before making any investment decisions.